Hello everyone, welcome back to another video. Today we're going to be covering Chapter 6 of the Investment Banking Valuation, Leverage Buyouts, and M&A second edition textbook by Joshua Rosenbaum and Joshua Pearl. And in this chapter we're going to be talking about sell-side M&A. As always, I do recommend that you purchase this textbook. It's a fantastic book for anyone who's interested in entering the investment banking industry or who's preparing to go into the private equity industry. So for any students or kind of first, second year kind of analysts, this is a very, very good textbook providing a great real-world overview of the industry. So let's get started. So the sale of a company, division, business, or collection of assets is a major event for its owners, management, employees, and other stakeholders. It is an intense, time-consuming process with high stakes, usually spanning several months. The seller typically hires an investment bank and its team of trained professionals to ensure that key objectives are met and a favorable result is achieved. Now, once the decision to sell has been made, the sell-side advisor seeks to achieve the optimal mix of value maximization, speed of execution, and certainty of completion among other deal-specific considerations for the selling party. Options include a broad auction, a targeted auction, and a negotiated auction. So we're going to be talking about these. As well, I've provided some investment banking interview kind of practice questions that you can go over on the channel. So I do recommend that you go check those out because we do cover the broad, the different types of auctions and sales from a sell-side M&A perspective. So if the seller is largely indifferent towards confidentiality, timing, and potential business disruption, the advisor may consider running a broad auction, reaching out to as many potential bidders, interested parties as reasonably possible. Alternatively, if speed, confidentiality in a particular transaction structure, and/or cultural fit are a priority for the seller, then a targeted auction where only a select group of potential buyers are approached, or even a negotiated sale with a single party may be more appropriate. And so we'll go through the advantages and disadvantages of each auction type. From an analytical perspective, a sell-side assignment requires the deal team to perform a comprehensive evaluation of the target using methodologies discussed in previous videos. So we've covered in Chapter 1 the comparable companies analysis. In Chapter 2, we talked about the precedent transactions analysis. Chapter 3, we learned about the discounted cash flow model. And in Chapter 4, we learned about the leverage buyout model. So these videos are all on my channel. So that we've covered the technical side of the discussion. And now we're taking those and we're seeing how they're applied in sell-side M&A. And in the next video, we're going to be talking about buy side for Chapter 7. So an effective sell-side advisor seeks to push the buyer towards or through the upper endpoint of the implied valuation range for the target. On a fundamental level, this involves properly positioning the business and tailoring the sale process accordingly to maximize its value. Now, auctions. An auction is a staged process whereby a target is marketed to multiple prospective buyers. A well-run auction is designed to have a substantial positive impact on value, both in terms of price and terms, received by the seller due to a variety of factors related to the creation of a competitive environment. Now, a successful auction requires significant dedicated resources, experience, and expertise. Up front, the deal team establishes a solid foundation through the preparation of compelling marketing materials, identification of potential deal issues, coaching of management, and selection of an appropriate group of prospective buyers. So the auction process is very good when it comes to maximizing value because the more bidders you have, the more competitive that bidding environment is. And especially if there are different, from a financial sponsor perspective, if there are different private equity companies that want to kind of merge and combine to make a joint bid for a company, then you can really push up the value of that respective sale. So from an auction perspective, the benefit is that you're pushing up the value of the sale by creating a bidding and competitive bidding environment. Now, an auction provides a level of comfort that the market has been tested, as well as a strong indicator of inherent value, supported by a fairness opinion, which we'll talk about later. At the same time, the auction process may have potential drawbacks, including information leakage into the market from bidders, negative impact on employee morale, possible collusion among bidders, which will reduce the bid, reducing negotiation leverage once a winner is chosen, thereby encouraging retrading, and a taint in the event of a failed auction. So there are some downsides. So you are increasing the competitiveness of the bidding environment. But at the same time, with an auction, you're exposing the company through the due diligence process to many more buyers and therefore sharing confidential information as you go later on into the auction process with more people. And therefore, those people are going to know about your company. So really, information leakage is probably the riskiest side of the auction process. In addition, there can be potential collusion and retrading, which essentially retrading means that you're backing out of a deal. So you've gone through the auction process and you've selected that, yes, this company seems like the most viable acquirer for our business, so they've submitted an offer. But then, as the other bidders walk away from the table, the guy's like, you know what? I'm going to lower that bid a little bit. And all of a sudden, you're stuck with this guy who, again, like there are a lot of kind of soft side analysis that needs to be done when you're looking at that potential bidder, because you need to ensure that the integrity of that bidder, to ensure that the bid and that is submitted will be the bid that is accepted. And so retrading is a potential risk. Now, there are two primary types of auctions. There's the broad auction, which maximizes the universe of prospective buyers approached. This may involves both strategic buyers, potentially including direct competitors, which is, from an information leakage perspective, is very risky, and financial sponsors. It's designed to maximize competitive dynamics, thereby increasing the likelihood of finding the best possible offer. Now, a targeted auction focuses on a few clearly defined buyers that have been identified as having a strong strategic fit, as well as the financial capacity to purchase the target. This process is more conducive to maintaining confidentiality and minimizing business disruption to the target. So with the targeted auction, you're selecting only a select few bidders who are both serious and at the same time who are the least risky from an information leakage perspective and a retrading perspective. Now, here's a more broader analysis of the advantages and disadvantages of broad and targeted auctions. As we talked about before, the core advantages with the broad auction, the value of that business is significantly higher because you're creating a much more competitive bidding process, whereas with the targeted, you're selecting fewer, and so you might leave some money on the table. With the disadvantages, the broad auction, information leakage is the big one, whereas with the targeted auction, the disadvantage really comes from leaving that money on the table. So that's the big core. With targeted auctions, the advantage is, again, you're ensuring the completion of the transaction. So when you're choosing the select few that you're opening up the sale of the company to, you're asking yourself, okay, not only is this guy real, but at the same time, it's probably likely that if we do choose them and choose to go with them and sell the company to them, the regulators are going to be receptive to allowing us to complete that transaction. So the efficiency and timing of that transaction is reduced. So the time it takes to complete the transaction is much quicker, and therefore the business disruption is much less. Okay? So the auction structure. Now, a traditional auction is structured as a 2-round bidding process that spans for 3 to 6 months. The timing of the post-signing period depends on a variety of factors not specific to an auction, such as regulatory approvals and/or third-party consents, financing, and shareholder approval. Right? So the structure is that we first, the organization and preparation stage is where we, as a sell-side advisor, the investment bank, conduct our own due diligence on the company that has hired us, determine what acceptable valuation range is. We also kind of do a little research on the companies that are potentially going to bid on our client. And then we go into the first round where we attract the first bids. We offer some information, the teasers, to attract that interest. In the second round, we round it down to the people who are very serious. We offer more information. We sign confidentiality agreements. And then you go into the negotiations phase where you receive the final bids and then close out the transaction. And so this can take about 3 to 6 months. And then afterwards, the moment that you close the transaction, that can take much longer, especially for mega mergers, whether it's, multi-billion-dollar deals. Regulatory approval, we need to have that regulatory approval, and that can take quite a long time, especially if the companies are very, very large. So even though the 3 to 6 month timeline for the closing of the deal is relatively quick, the post closing of that deal, post agreeing on the terms to really complete the transaction, that can take up to 2 years. So it can be quite a long process. And so this is just more of now we're going to go into the organization preparation stages. And so this essentially outlines kind of the 5 steps within the first level of the auction structure. We first identify the seller objectives and determine appropriate sale process. We then perform our due diligence on the company. We then select a buyer universe. We then prepare the marketing materials and then prepare the confidentiality agreement so that we can go out and then seek those buyers. So we'll go through each of them. So number 1, identify the seller objectives and determine appropriate sale process. So at the onset of an auction, the sell-side advisor works with the seller to identify its objectives and determine the appropriate sale process to conduct and develop a process roadmap. The advisor must first gain a clear understanding of the seller's priorities so as to tailor the process appropriately. While a broad auction may be more appealing to a seller in certain circumstances, a targeted auction may better satisfy certain softer needs such as speed of transaction closing, heightened confidentiality, and a tailored transaction structure and less risk of business disruption. So it depends all on the owner. Especially for smaller companies, a targeted auction is much more likely, whereas with a big company that's really seeking just to maximize shareholder value, a broad auction might be the better opportunity. So furthermore, the target's board of directors must also take into account its fiduciary duties in deciding whether to conduct a broad or targeted auction. So the decision isn't made just by the sell-side advisor, it's made together with the company itself. When the sale of control or the breakup of a company has become inevitable, the directors have the duty to obtain the highest price reasonably available. There is no statutory or judicial blueprint for an appropriate sale or auction process. So there's a lot of negotiation here. Like if the board of directors feels that there's no way that this company can continue on its own, we're just going to have to sell the business, then the broad auction is the best option. But if, they have an option to kind of choose to work independently and just continue as their own entity or sell themselves to a respective buyer, then a targeted auction seems the more likely option. Now, the next step is to conduct a sell-side due diligence and valuation analysis. So the sale process preparation begins with extensive due diligence on the part of the sell-side advisor. This typically kicks off with an in-depth session with target management. The sell-side advisor must have a comprehensive understanding of the target's business and the management team's vision prior to drafting marketing materials and communicating with prospective buyers. An effective sell-side advisor understands the valuation methodologies that buyers will use in their analysis. For specific public companies, accretion dilution analysis and balance sheet effects are also performed to assess their ability to pay. In the event of a stapled financial package, of which is to be provided to the bidders, which is a separate financing deal team. A separate financing deal team is formed either at the sell-side advisor's institution or another bank to begin conducting due diligence in parallel with the sell-side team. So essentially, the second step is, we've conducted our due diligence and we've learned about the company and we determine how valuable is the company based on these certain assumptions. And being that we're the sell-side advisor, we can sit down with management and really understand fully the company. Now, the financing package, the stapled financing package, essentially is a kind of a package that can be offered to bidders. So when the bidder offers a bid, we can then come back to them with this staple financing package and say, hey, if you're going to raise this X amount of dollars in debt, well, we can do that for you, and these are our terms. So we've prepared that, and that expedites the sale process. But most of the time, that stapled financing package is taken. You look at the fees, and then you go to other banks, and you're like, this is what they're offering us. Can you do better, right? So in many cases, you don't the bidders never really do take the stapled financing package, but in some cases they do, and if they do, the financing the speed of the transaction is much quicker. Okay, so now we select the buyer universe. So the selection of an appropriate group of prospective buyers and compilation of corresponding contact information is a critical part of the organization and preparation stage. Sell-side advisors are selected in large part on the basis of their sector knowledge, including their relationships with and insights on prospective buyers. So one of the big reasons an investment bank, a boutique investment bank, might be selected is because they work in a respective industry. So they have all these contacts. And for companies in that industry, they hire that investment bank for their contacts because they know, okay, we want to sell this business. We want to conduct a targeted auction. Who are the potential buyers that will go into this bidding process? And so the investment bank themselves will analyze the buyers. And so this selection of the buyer universe is very, very important in order to get, the safest bids from a sharing of confidential information while also getting, the highest bids possible. So when evaluating strategic buyers, the banker looks first and foremost at strategic fit, including potential synergies. Financial capacity or the ability to pay, which is typically dependent on size, balance sheet strength, access to financing, and risk appetite, is also closely scrutinized. Other factors play a role in assessing potential strategic bidders, such as cultural fit, an M&A track record, existing management's role going forward, and relative pro forma market position, including antitrust concerns and effects on existing customer and supplier relationships. So really, there's a lot of things to consider with regards to the buyer universe. The best way I can explain it and communicate it to you is when we look at the comparable companies analysis or precedent transactions analysis, the entire analysis is based on the relevant companies that we're comparing our company to. right? So selecting that universe of companies is the key step in that process, similar to sell-side M&A, where the key step in sell-side M&A is finding the right buyers, the right potential buyers. So this buyer universe, you have to spend a lot of time as a sell-side advisor to understand the industry, understand the needs of the companies, not only the bidders, but the selling company, and see how they form and merge together once a transaction is completed. Okay, so when evaluating potential financial sponsor buyers, key criteria include investment strategy focus, sector experience, fund size, track record, fit with an existing investment portfolio, fund life cycle, and ability to obtain financing. So as part of this process, the deal team looks for sponsors with existing portfolio companies that may serve as an attractive combination candidate for the target. So we talked about in the buyer universe, there can be strategic buyers, which are competitors or people who work in that industry, or there can be financial sponsors, which are private equity companies, hedge funds. So with financial sponsors, the potential for synergies is much lower. But at the same time, you have to understand that financial sponsor. So if you have a private equity firm and they're going to use a fund that is a 10-year fund, it was raised 7 years ago, well, then they have to return that cash 3 years from now. How is that going to impact, the investment? So they have to flip this company in the next 3 years to realize a return on their equity. Is that possible? Whereas if that private equity company were to use funds from money raised a year ago and it's a 10-year fund, then they have 9 years to really work with that company. So you have to really kind of ask yourself, okay, what are the financial sponsors' needs and perspectives when it comes to making this investment in that company? Okay, now we prepare the marketing materials. So marketing materials often represent the first formal introduction of the target to prospective buyers. They are essential for sparking buyer interest and creating a favorable first impression. Effective marketing materials present the target's investment highlights in a succinct manner. The two main marketing documents for the first round of an auction process are the teaser and the Confidential Information Memorandum, the CIM. Okay. Now the teaser, it is designed to inform buyers and generate sufficient interest for them to do further work and potentially submit a bid. The teaser is generally a brief 1 or 2 page synopsis of the target, including a company overview, investment highlights, and a summary financial information. Now, regulation FD concerns govern the content of the teaser. So really, the important thing to remember with regards to the teaser is that you're offering a summary on the company to spark interest. But the initial buyer contact or teaser can put a public company in play and may constitute the selective disclosure of material information. So in that teaser, you can't offer non-public information, or you can't really present that company in a way that we have to sell this company. Because from a legal perspective, if you do that, then the board of directors is obligated to release a press release that will indicate shareholders, inform shareholders that the company is in play. And all of a sudden, the bidding process turns into a broad auction. You can't really control it anymore and make it a targeted auction. So that's really important. The information that you put in the teaser defines what the auction will be. If you want it to be a targeted auction, then you have to make sure that everything is public information. And at the same time, it's more of a, hey, learn about this company, see if you're interested in it. Not, hey, we're selling, you would be a good buyer for this. So even the wording of the teaser is very, very important. Okay, and this is an example of a 2-page teaser. You have the transaction overview over here. Where's my mouse? The transaction overview right over here, talking about the potential for what this company can offer, not directly to you, but just the potential, a company overview, what it has to offer, product mix and market, and some investment highlights and financial information, which really communicates, okay, this is what the company has to offer. Are you interested? Right? So this sparks initial interest. Then the CIM is a detailed written description of the target. So this is a 50-plus page document that serves as the primary marketing document for the target in an auction. The deal team, in collaboration with the target's management, spends significant time and resources drafting the CIM before it is deemed ready for distribution to prospective buyers. A modified version of the CIM may be prepared for designated strategic buyers, namely competitors with whom the seller may be concerned about sharing certain sensitive information. So with the CIM, it's a full document, a very long document, including all of the relevant information about the company to really offer a lot of information so that that prospective buyer can really do more research and learn about the company. Now, usually what happens is that in the next slide, we're going to look, essentially, the teaser is sent out first. you spark the interest of the buyer, and the buyer comes back and is like, you know what, I'm interested. Can you send some more information? The next thing you do is you send a CA, a confidentiality agreement, which the potential buyer signs in order to ensure that this information doesn't leak. And then you go and send out the CIM to then provide further information. And so this is kind of how it looks. This would be the table of contents. So there would be an executive summary, investment considerations. Then the sell-side advisor provides an industry overview. So they share their research, the company overview, operations overview, financial information, further information in the appendix. So it's a very, very long document, essentially offering all the information you kind of really need to know about the company and whether the company fits in that respective financial sponsor's portfolio or the strategic buyer. So this is the next step that really engages the company or the prospective bidder to make a bid. So this is much more, has confidential information, okay? So what about the financial information in the CIM? So this section is very important. Essentially, anyone any private equity analyst, when they receive a CIM for a potential company, they always they read the front, they read about the company first, and then they go right to the back to the financial information because the numbers tell the story. So the CIM contains a detailed financial section presenting historical and projected financial information with accompanying narrative explaining both past and expected future performance. The sell-side advisor also helps develop a set of projections, typically 5 years in length, as well as supporting assumptions and narrative. In some cases, the CIM provides additional financial information to help guide buyers towards potential growth acquisition scenarios for the target. So that's why when we talk about sending the teaser first, after you send a CA, confidentiality agreement, because there is a lot of valuable information and management projections that don't want to be shared with people who might not be really interested in the company. And at the same time, this is something that I missed over here in this slide, a modified version of the CIM is done for any strategic buyers, competitors in the same sector. So if you are interested in selling your business, but at the same time you're not sure if your competitor is really going to go through, you don't want to send a CIM with all the secrets to your business. You want to send a modified one, which kind of brings them along until they really sign, further documents and really get committed in the process. Because again, at the end of the day, if you sell that business and your competitors learned about that business, they are better equipped to really perform and outperform you in the market. So that's really important. So there's a little bit of a balance there. Now, the CA, the confidentiality agreement. So a CA is a legally binding contract between the target and prospective buyers that governs the sharing of confidential company information. It is distributed to prospective buyers along with the teaser, with the understanding that the recipient of more detailed information is conditioned on execution of the CA. So essentially, you send the teaser, you then send the CA, they sign it. Of course, they'll negotiate on certain terms, and then you'll send this a CIM. Okay, so here are some of the terms in the contract itself. So there's the use of information, which essentially all proprietary information is confidential. So any information that is shared in the bidding process, you cannot share. And there's a term. So the term defines how many years you can't share that information with. And usually that term extends to about 2 years. So 2 years onwards, once the bidding process ends, you have about 2 years in which you have to keep that information secret. And after the 2 years, you can kind of speak about it. Right? There's also permitted disclosures, what you can actually disclose, and there's also the return of confidential information, which mandates the return or destruction of all provided documents once the prospective buyer exits the process. And this is a very important term because it essentially mandates that the buyer who fails to acquire the business in the auction process then has to destroy all of the information that was provided about the business. So all the analysis that they conducted about the business, they have to destroy that and get rid of it so that they can't keep that on file and then someone comes across it and discloses it and all of a sudden there's an information leakage. Okay? There's non-solicitation or no hire, which prevents prospective buyers from soliciting to hire target employees for a designated time period. There's a standstill agreement for public targets, which precludes prospective buyers from making unsolicited offers or purchases of the target shares. So you can't acquire the shares of that respective company, which is in the bidding process. And there's also restrictions on clubbing, which prevents prospective buyers from collaborating with each other or with outside financial sponsors, equity providers, without the prior consent of the target. So essentially, if you are the strategic sponsor who's interested in acquiring, so a potential competitor, but you don't have enough money you want to partner with a private equity firm, well, this restriction, this term in the contract means that you have to first go to the seller, the sell side advisor, inform the investment banker that, hey, we're interested in working alongside a private equity firm. Are we allowed to? And then you're able to work with it. So there are a lot of things that, again, this is all open to negotiation. When you send the confidentiality agreement, you send it. Then the lawyers of the potential bidder look at it and they make some changes and they send it back. And then, you kind of settle on what is a fair CA and then finally sign it. Okay. So in the first round, we contact the prospective bidders. We negotiate and execute that confidentiality agreement. We then distribute the CIM. We then prepare a management presentation. We set up a data room. We then prepare the stapled financing package if the bidders are interested in that, and then they receive the initial bids. So in the first round, okay? So let's go through it. So contact prospective buyers. So the first round begins with the contacting of prospective buyers, which marks the formal launch of the auction process. This typically takes the form of a scripted phone call to each prospective buyer by a senior member of the sell-side advisory team, either an M&A banker or the coverage banker that maintains the relationship with the particular buyer, followed by the delivery of the teaser and the CA. So you send that teaser, you then send the CA. If they sign the CA and they confirm that they're interested in learning more, you then send the CIM. Okay? So upon receipt of the CA, a prospective buyer presents the document to its legal counsel for review. In the likely event that there are comments, the buyer's counsel and seller's counsel negotiate the CA with input from their respective clients. Following execution of the CA, the signing of that confidentiality agreement, the sell-side advisor is legally able to distribute the CIM and initial bid procedures letter to a prospective buyer. The initial bid procedures letter essentially defines, what you need to offer in your preliminary bid. So for the first bid, you say, okay, this is what I need from you in order to confirm the first bid in the process, okay? So the initial bid procedures letter, which is initially sent out to prospective buyers following distribution of the CIM, states the date and time by which interested parties must first submit their written, non-binding preliminary indications of interest. And this includes the indicative purchase price in form of consideration, info on financing sources, the treatment of management employees, and other key conditions. Essentially, the IOI, the initial bid procedures letter, really what you want to define is a preliminary bidding range. So they won't require you to submit an exact bid like $5 million, but rather you're going to submit a bid of potentially how much you want to bid for the company. And so you define it as, okay, we're going to bid between 7 and 10. Right? And so you set that range, and then you also define, okay, and with that $7 to $10 million bid, we're going to finance, around 60% of it with debt and 40% with cash on hand, right? And so you offer that information of how your bid is going to be structured in order for the sell-side advisor to then learn about that bid and make a decision on whether that's a serious enough bid for the company to offer more confidential information. Okay? So now the management presentation. So the management presentation is typically structured as a slideshow with accompanying hard copy handout. The sell-side advisor takes the lead on preparing these materials with substantial input from management. In parallel, the sell-side advisor works with the management team to determine the speaker lineup for the presentation, as well as key messages and the preparation of answers for likely questions. Right? So essentially, you're preparing the management presentation for the second round. In this second round, the moment that you've received these initial bids, the preliminary bids, you then make a decision who really is serious, and they go on to the second round. You then present this management presentation. And so the preparation begins in the first round. Okay? You also set up the data room, which will be opened in the second round. The data room serves as the hub for the buyer due diligence that takes place in the second round of the process. It is a location, typically online, where comprehensive detailed information about the target is stored, cataloged, and made available for pre-screened bidders. A well-organized data room facilitates buyer due diligence, helps keep the sale process on schedule, and inspires confidence in bidders. While most data rooms follow certain basic guidelines, they may vary greatly in terms of content and accessibility depending on the company and confidentiality concerns. So this is a lot of, really this data room and the setup of this data room, you have to work alongside the legal counsel of the sell side buyer sell-side advisor in order to really determine, okay, how are we going to provide this information to each of the sellers? If we have financial sponsors and strategic buyers, we have to set up 2 different data rooms because the relevance of information differs between the two. For the strategic buyers, maybe we have to hold back a little bit of information, whilst for financial sponsors, we can offer much more information. So it depends, again, on what legal counsel says. And so this is kind of a screenshot of the Intralinks. This is one of the sites available where they set up a portal for any potential bidders to go in and kind of learn about the company, and you have all these relevant documents in here. And so back in the day, it was actually in the law office for that respective counsel, but now it's on a portal online. Okay. You also prepare the stapled financing package, which we already talked about, so we don't really want to go into that. And also to avoid a potential conflict of interest. So remember, especially if the sell-side advisor, the investment bank, is a big investment bank which has a commercial banking group as well, and they want to offer that financing package from the same bank, there is a potential for a conflict of interest whereby the M&A advisor will share confidential information with the deal team that offers the bond, the financing of that deal. So really what happens, and it's a little inefficient, but essentially to maintain that, to avoid that conflict of interest, what happens is the M&A advisor conducts their due diligence and of course then begins to go through that auction process, whereas if they're prepared to offer a stapled financing package, the commercial banking team also conducts due diligence on the company, but does not have access to a lot of that confidential information that the M&A team has, even though they work for the same company. But that's how you avoid that conflict of interest when you do prepare this stapled financing package. Finally, you go through it, you send out the marketing materials, you've offered the initial letter of intent, and now you receive the initial bids and select the specific buyers that are serious. So on the first round bid date, the sell-side advisor receives the initial indications of interest from prospective buyers. Over the next few days, the deal team conducts a thorough analysis of the bids received, right? And remember, we have a range, the potential financing, the form of consideration, and further information about that bid to determine if they're serious. An effective sell-side advisor is able to discern which bids are real, less likely to be retraded. Furthermore, it may be apparent that certain bidders are simply trying to get a free look at the target without any serious intent to consummate a transaction. And so that's really that's where experience from the sell-side advisor's perspective is needed. You need a seasoned investment banker who can look at these initial bid offers and determine who is really interested in the company and who is just looking for that free insight into the company's internal information. Okay. So the sell-side advisor performs similar analysis in parallel to determine the maximum price a given buyer may be willing to pay. This requires making assumptions regarding each specific acquirer's financing mix and cost as well as synergies. So when they receive these, and so in this example, we have 8 bidders. And so for these 8 bidders, they offer that range, right? So for bidder 1, they defined it between 5.6 billion and 6.25 billion, whereas bidder 8, defined their, bidding range between 5 billion and 5.6 billion, right? Even though, these guys are much higher in value, you have to also analyze the mix of that. So if this is, again, if this is a financial sponsor, is financing the deal 80% bonds and 20% equity, and we're at near the top of a market, and there's a risk of not being able to finance the deal properly or being put in a difficult position to really kind of complete the deal, then you may even rule out the top bid, because at the end of the day, you want to make sure that you're looking at the most real and stable bid. Right? And so this, again, comes through the experience of the investment banker to judge and analyze the letters of intent. Okay, now we go into the second round. The second round of the auction centers on facilitating the prospective buyer's ability to conduct detailed due diligence and analysis so they can submit strong, final, and ideally binding bids by the set due date. The due diligence process is meant to be exhaustive, typically spanning several weeks. So in the second round, they conduct the management presentations to offer more insight onto with regards to the company. You then facilitate site visits to learn about the company and its operations, provide access to that portal, that data room. You distribute the final bids procedures letter and draft definitive agreements to get those final bids. And then you receive the final bids, and then you can analyze those bids in the later round. Okay, so the first one is conducting the management presentations. So the management presentation typically marks the formal kickoff of the second round, often spanning a full business day. At the presentation, the target's management team presents each prospective buyer with a detailed overview of the company. This involves an in-depth discussion of topics ranging from basic business, industry, and financial information to competitive positioning, future strategy, growth opportunities, synergies if appropriate from a strategic buyer perspective, and financial projections. You then facilitate site visits. So I'm kind of rushing through it because it's quite a long presentation. I mean, I'm talking a lot, but there's a lot of words. But essentially, with regards to the management presentation, you've now determined these 5 bidders are the most serious bidders. You bring them in, with their buy side advisors. You sit them in a room, and then you present more about the company. You present more about projections. You present more about operations, so they can learn really and conduct a proper due diligence analysis of the company. Right? You take them to the site. They learn about the operations. So site visits are an essential component of buyer due diligence, providing a first-hand view of the target's operations. Often, the management presentation itself takes place at or near a key company facility, includes a site visit as part of the agenda. Prospective buyers may also request visits to multiple sites to better understand the target's business and assets. In many cases, the seller does not reveal the true purpose of the site visit, as employees are often unaware a sale process is underway. Now, in conjunction with the management presentation and site visits, prospective buyers are provided access to the data room, this portal. Serious bidders dedicate significant resources to ensure their due diligence is as thorough as possible. So they have to go through all of those documents that are available in the data room. They often enlist a full team of accountants, attorneys, consultants, and other functional specialists to conduct a comprehensive investigation of company data in order to determine whether this company really is a good fit for them and at the same time will offer increased shareholder value. Now, the final bid procedures letter outlines the exact date and guidelines for submitting a final, legally binding bid package. The requirements are an exact dollar offer in form of consideration, a markup of definitive agreement provided by the seller, which is a letter of intent, an LOI, evidence of committed financing, and an estimated time to sign and close the transaction. So relative to the initial bid procedures letter, where we set a range and kind of a range on the financing, a mix of consideration for the transaction, and some preliminary information, with the final bid procedures letter, you're giving an exact dollar value, an exact form of consideration. You're making sure that you're already you have evidence of committed financing. So you've gone to the investment banks that will help you raise that money, and they've signed off and they said, yes, we can raise X amount of dollars, which you've defined in the consideration section. And at the same time, you've provided a letter of intent, which makes sure that you are sure to make this bid and are committed to this bid, so that there is no retrading. Okay, so the definitive agreement is a legally binding contract between a buyer and seller detailing the terms and conditions of the sale transaction. In an auction, the first draft is prepared by the seller's legal counsel in collaboration with the seller and its bankers. Ideally, the buyer is required to submit a form of revised definitive agreement that it would be willing to sign immediately if the bid is accepted. Often, the buyer's and seller's legal counsel pre-negotiate certain terms in an effort to obtain the most definitive agreement. So essentially, when it comes to this agreement, not only are they submitting the exact dollar bid on that respective due date for which the seller is set, but they're also pre-signing the definitive agreement. So they've agreed upon, okay, this is the contract which states that I'm doing this, I'm submitting X amount of dollars, and this is the form of financing, and I have the committed financing. And so really what happens is once the sell-side advisor decides on the best bid, all they have to do is go pull out the definitive agreement which was submitted and sign their side, and that's it, right? And this ensures that there's no retrading, okay? Now, the negotiations. So once the final bids are received, the sell-side advisor evaluates the final bids, negotiates with the preferred buyer, selects the winning bidder, and then renders a fairness opinion to make sure that that they went through the auction process and maximize shareholder value, so that they have a fiduciary duty to select the best bid, and then they receive a board approval and execute the definitive agreement. So then they sign on their side. But they already have, from the bidder side, the definitive agreement is already sent to them. So all they have to do is sign it. So that's really what we talked about in the previous slide over here. Okay, So the sell-side advisor works together with the seller and its legal counsel to conduct a thorough analysis of the price, structure, and conditionality of the final bids. Purchase price is assessed within the context of the first round bids and the target's recent financial performance, as well as the valuation work performed by the sell-side advisors. A bid with a superior headline offer price but significant conditionality may be deemed weaker than a firmer bid at a lower price. And this is really important. So essentially, when they receive the bids, it's not as easy as choosing the highest number. That's not how it works. I read, I'm not sure if anyone else has read Barbarians at the Gate. It's a great book about the leverage buyout, the LBO of RJR Nabisco by KKR. And, they were bidding against Shearson Lehman. It was another bidding party. And actually, if you were to read the book, you'd actually know that Shearson Lehman offered a final bid that was higher than KKR, even though KKR won the auction process. And the reason is that essentially there was a reset option on their bonds. So with Shearson Lehman, they offered, I believe, $2 a share higher, but the financing that they offered, they said, okay, we're going to raise these bonds, but we're not going to set a reset. So if the value of the bonds falls by significant margins, the interest rate on those bonds will not reset. Whereas with KKR, they committed to that reset option in order to ensure the value of the bonds stays at a higher level and therefore ensure a safer transaction and therefore higher demand for the financing of that deal. Because at the end of the day, when you're completing a transaction, you don't have that money right away. You don't want to put yourself in a position where you are the bidder and you want to bid $5 billion and you need to raise $4 billion through debt. And you're not sure if you've won the bid already, but you're going to raise that money right away. What happens is you wait, you submit that, and you say that I'm going to raise that $4 billion, and this is how I'm going to do it. These are the terms on my bonds that I'm going to offer. I got the sign off from the commercial bank who's going to raise that money, and they're confident that we can raise that money. And so that's what the sell-side advisor looks at. They look at, can they seriously raise all that money to meet their final bid? Right? And if they do, versus others who might offer a higher price but are not less likely to really complete that financing, then they're going to choose a lower bid in order to ensure the completion of the deal. And now, often the sell-side advisor recommends that the seller negotiates with two or more parties, especially if the bid packages are relatively close or there are issues with the higher bidder's markup of the definitive agreement. Skillful negotiation on part of the sell-side advisor at this stage can meaningfully improve the final bid terms, because at the end of the day, they negotiate with probably two or three, and they know that if they can kind of disclose to them, yes, we still have other people in the race, then they'll probably increase their bid by another $1 or $2 a share, and that can really maximize the value of the business. So while tactics vary broadly, the advisor seeks to maximize a level playing field so as not to advantage one bidder over another and maximize the competitiveness of the final stage of the process. The sell-side advisor and legal counsel negotiate a final definitive agreement with the winning bidder, which is then presented to the target's board of directors for approval. Not all negotiations result in a successful sale. The seller normally preserves the right to reject any and all bids as inadequate at every stage of the process. And that does kind of happen sometimes, especially if demand from the bidding side is very low, or the bids that are offered are quite low and do not really capture the full value and potential of the selling firm. So it depends again on the sell-side advisor and how comfortable they are in accepting those bids, because again, they have to act in the interest of shareholders. Shareholders are focused on maximizing the total value of their share, and if you just want to complete the transaction to get those fees, then the shareholders can sue you. So again, you want to make sure that you're following the law all the way to the very end. So in response to a proposed offer for a public company, the target's board of directors typically requires a fairness opinion to be rendered as one item for their consideration before making a recommendation on whether to accept the offer and approve the execution of a definitive agreement. For public companies, selling divisions or subsidiaries, a fairness opinion may be requested by the board of directors depending on the size and scope of the business being sold. The board of directors of a private company may also require a fairness opinion to be rendered in certain circumstances, especially if the stock of the company is broadly held, i.e. there are a large number of shareholders. So essentially, a fairness opinion is a third-party analysis of that respective bid. So say, for example, the sell-side advisor receives a final real bid, a very strong bid, and they say, okay, ABC Corp has bid for XYZ. And so we're now going to go to a third-party investment bank and present ABC Corp's bid, and we're going to say, is this fair? And so they will conduct a quick, unbiased analysis of that bid, and they will sign off and say, yes, we as this investment bank confirm that this is a fair valuation of the business. And then in joint with the bid and with the fairness opinion, that is presented to the board of directors, who, as I said before, have a fiduciary duty to represent the shareholders. And so with that fairness opinion, it legitimizes the bid. It says that, yes, it is a fair bid that maximizes shareholder value. So really, the shareholders can't sue the company if the transaction is completed and they feel, it was unfair. They accepted too low of a price. The board of directors can show them the fairness opinion and say, no, that's what the industry executives, the professionals say we could have gotten. So it's a fair bid. It's a fair transaction. Okay. So a fairness opinion is a letter on the fairness of the consideration offered in a transaction. The opinion letter is supported by detailed analysis and documentation, providing an overview of the sale process run, as well as an objective valuation of the target. The valuation analysis typically includes comparable companies analysis, precedent transactions, the DCF analysis, and a LBO analysis if applicable, as well as other relevant industry and share price information, benchmarking analyses. So it's all, they conduct a quick due diligence. They conduct it to make sure that, yes, we are standing by this transaction and saying that it is a fair valuation of the company. So who generates the fairness opinion, by the way? Well, historically, the investment bank serving as the sell-side advisor to the target has typically rendered the fairness opinion. This role was supported by the fact that the sell-side advisor was best positioned to offer an opinion based on its extensive due diligence and intimate knowledge of the target. The process conducted and the detailed financial analyses already performed would speed up the completion of the fairness opinion. In recent years, however, the ability of the sell-side advisor to objectively evaluate the target has come under increased scrutiny. The sell-side advisor has an inherent bias towards consummating a transaction when a significant portion of the advisor's fee is based on the closing of the deal, or if a stapled financing package is provided by the advisor's firm to the winning bidder. Thus, an independent boutique is now hired separately. So before, fairness opinions were conducted by the same sell-side advisor, but now they take a third-party investment bank who's unbiased towards the completion or completion of the deal. Okay? So now you received the board approval. So once the seller's board of directors votes to approve the deal, the definitive agreement is executed. So they sign it by the buyer and the seller. A formal transaction announcement is agreed to by both parties, and it is made with key deal terms disclosed depending on the situation to the public shareholders. And now you obtain the necessary approvals and then finance the deal and close it in the final closing stage. So once the regulators have approved the transaction in accordance with the Hart-Scott-Rodino Antitrust Improvements Act of 1976, the shareholders have two different approval paths. They can do a one-step merger or a two-step tender process. So those are the two ways you can kind of consummate the deal. In a one-step merger transaction for public companies, target shareholders vote on whether to approve or reject the proposed transaction at a formal shareholder meeting pursuant to relevant state law. Prior to the meeting, a proxy statement is distributed to shareholders describing the transaction, parties involved, and other important information. Shareholder approval is typically determined by a majority vote of 50.1% or above, and some companies, in their bylaws have defined majority approval at 60 or 80%, so it depends on the company. But the one-step merger is relatively the simplest way. They vote on it at the shareholder meeting. If the majority of shareholders votes to complete the transaction is completed. Right? The two-step tender process, however, is more complicated. So alternatively, a public acquisition can be structured as a two-step tender offer on either a negotiated or unsolicited basis, followed by a merger. So in the first step, the tender offer is made directly to the target's public shareholders with the target's approval pursuant to a definitive agreement. The tender offer is conditioned, among other things, on sufficient acceptances to ensure that the buyer will acquire a majority, typically 90% of the target's shares, within 20 business days of launching the offer. If the requisite threshold of tendered shares is reached as designed, the acquirer can substantially consummate a back-end short-form merger to squeeze out the remaining public shareholders without needing to obtain shareholder approval. So essentially with the two-step tender process, the first step is similar to the merger process, the one-step merger process, where they offer they offer a tender offer to the shareholders, and if 90% or more shareholders approve the tender offer, approve of the bid, then they finish the transaction by squeezing out the remaining 10% of shareholders. However, if they do not meet that threshold, all of a sudden the second half of the merger needs to follow the one-step merger transaction, where they go to a proxy vote, they vote on it at a shareholder meeting, and the remaining, say, 15 or 20% of shareholders need to approve on the deal, or maybe go back to the bidder and renegotiate for a higher price. So the two-step tender process is usually quicker if they do reach that 90% threshold. But if they don't, then what happens is they have to go through the proxy voting process, and they have to set up a shareholder meeting. All shareholders have to offer their opinion, and they have to really approve the deal that way. So it can get quite long if they don't meet that threshold. Whereas with the one-step merger, all they have to do is they have to go to the shareholder meeting and approve the deal based on a majority basis set in the bylaws. So the short form merger occurs in the case of a parent corporation who is merging with another company, which it owns a large stake in. It is combining all of its business operations without a vote of the remaining shareholders of the subsidiary. So a lot of words. It's the end of the video. It's been a very, very long video. I'll sum it up. So the short form merger essentially means that if we do reach the 90% threshold, you can squeeze out the remaining shareholders by forcing them to approve of the bid rather than waiting for them to approve the bid. So it's a way to kind of squeeze them out because you already have a supermajority in that 90% that have already approved the transaction. So now the financing and closing, the final round. So in parallel with obtaining all necessary approvals and consents as defined in the definitive agreement, the buyer proceeds to source the necessary capital to fund and close the transaction. This financing process timing may range from relatively instantaneous, so the buyer may have the necessary cash on hand, or to several weeks or months for funding that require access to capital markets. So if they have to raise bonds, offer bonds in order to raise money, then that can take a longer time. The acquirer may also use bridge financing to fund and close the transaction prior to raising permanent capital or debt or equity. So in some cases, if the acquirer wants to complete the transaction right away, they can use a bridge loan offered by the investment bank to kind of bridge them that money, give them that money in the short term, and then they raise the money and pay off the bridge loan. Right? So they complete the transaction right away by getting that instantaneous access to capital, but then they have to still raise that debt or issue some equity in order to pay off the bridge loan itself. Now, we've talked about the auction process and we talked about the broad versus targeted auction. Now, there is another sale process, and don't worry, there's like 3 slides for this: the negotiated sale. In contrast to an auction, a negotiated sale centers on a direct dialogue with a single prospective buyer. In a negotiated sale, the seller understands that it may have less leverage than in an auction where the presence of multiple bidders throughout the process creates competitive tension. Therefore, the seller and buyer typically reach agreement upfront on key deal terms such as price, structure, and governance matters. A negotiated sale is often initiated by the buyer rather than the seller. So usually the buyer approaches them and is like, hey, you want to kind of conduct this negotiated sale. Let's talk about, how much you want for me to buy your business, right? So whether as the culmination of months or years of research, direct discussion between the buyer and seller executives, or as a move to preempt an auction. So essentially, a negotiated sale can arise from an existing relationship between the two businesses, where the buyer says, you know what, we've been working on so many deals in a joint manner that let's just merge, or let me just acquire you so that it will be easier to work under one umbrella rather than two. Right? And so that can take years, where they're working together, or they can also preempt an auction. So in certain cases, the buyer recognizes that the company is going to want to go into an auction process and sell the company. So they jump right in ahead, they talk about it, and they discuss a certain deal, and they close it right before they go into an auction process. So many of the key negotiated sale process points mirror those of an auction, but on a compressed timetable. So essentially the negotiated sale, the rounds, the round 1, 2, and the closing round, they're all the same. It's all the same. Essentially, though, there's only one buyer rather than multiple bidders. And because of that, there's no competitive environment. There's no kind of leveraging one bid off another to kind of increase the overall bid. Rather, it's just one company, and so that compresses the timetable. It speeds up the negotiation process. Okay, so as a means of keeping pressure on the buyer and discouraging a retrade, the sell-side advisor may preserve the threat of launching an auction in the event that two parties cannot reach an agreement. In some cases, a negotiated sale may move faster than an auction, as much of the upfront preparation, buyer contact, and marketing is bypassed. And so this is a quick overview of the advantages and disadvantages of a negotiated sale. Essentially, the key advantages with a negotiated sale, you're dealing with one buyer, so the degree of confidentiality is highest. The potential for information leakage is very low. At the same time, they probably know each other for a long time, so that the timetable, the amount of time necessary to complete a transaction is much lower. But at the same time, the big disadvantage with a negotiated sale is that you're dealing with one buyer, right? So you probably will leave some money on the table because there's no competitive bidding process in which to drive up the value of the business. So that's really the disadvantage with the negotiated sale. But this occurs a lot in the private market rather than the public market, because with private businesses, it's kind of a very power culture structure. So there's only one owner, like it's the owner, and he makes all the decisions rather than an executive team who responds to shareholders, right? So it's this one guy and he makes that decision. Usually it's much easier for him to negotiate directly with one buyer, and that's why negotiated sales are much more common in the private market. That's pretty much it. Oh my gosh, it's been 55 minutes. It's been a very long video, but it's a very, very important video for anyone interested in sell-side M&A advisory. That kind of anyone who's going into the investment banking industry. If you really, really want to learn about the industry before you jump right in, this is a great comprehensive video for the sell-side of the industry. As always, if you did like the video, please do like and subscribe to the channel for more. If you have any questions, please do comment below and I'll be sure to get back to you as soon as possible. And as always, if you guys need anything, if you want to comment below and let me know what video or topic you want me to talk about, then please do and let me know. As always, good luck guys, and take care.